The most powerful forces in global finance are completely invisible on a stock chart. Retail investors spend their days analyzing quarterly earnings. They look at price-to-earnings ratios, they listen to Federal Reserve press conferences, and they believe they understand the mechanics of the global economy. They do not. They are looking at the weather, while ignoring the tectonic plates shifting directly beneath their feet. Welcome to the Institutional View. Today, we are decoding the Great Decoupling. We are going to look past the illusion of the daily stock market and examine the permanent, structural fracturing of the global supply chain. More importantly, we are going to track exactly how the smartest money on Earth is positioning for a macroeconomic shock that has not occurred in over 70 years. To understand the future of institutional capital, you must first understand the lie that built the modern world. For the last 40 years, the Western economy has been completely dependent on a singular, massive deflationary force: cheap labor. In the late 1970s and early 80s, the global economy experienced an unprecedented demographic miracle. Hundreds of millions of working-age individuals entered the global supply chain, specifically from mainland China and Eastern Europe. This created a massive, seemingly endless pool of cheap, highly efficient labor. Western corporations realized they no longer needed to pay American or European factory workers middle-class wages. They could simply offshore their manufacturing to Asia. They could produce goods for pennies on the dollar, ship them across the ocean, and sell them to Western consumers at a massive premium. This dynamic is the singular reason corporate profit margins exploded over the last 3 decades. It is the reason the S&P 500 achieved historical, compounding returns. And it is the reason consumer goods, from televisions to clothing to electronics, became cheaper every single year. The global economy was operating in a state of perfectly synchronized globalization. But the institutions know that era is officially dead. And it is not coming back. The primary catalyst for this destruction is not politics. It is not trade wars. It is biology. We are currently witnessing the most rapid demographic collapse in recorded human history. And it is happening at the absolute center of the world's manufacturing engine. China's population is no longer growing. It is shrinking. Decades of the one-child policy, combined with rapid urbanization, have completely destroyed the replacement rate of the Chinese workforce. The seemingly endless supply of cheap labor has run out. The average age of a Chinese factory worker is climbing rapidly. Their wages have increased exponentially over the last decade. China is transitioning from a young, hyper-productive manufacturing hub into a rapidly aging society burdened by a massive elderly population. When the primary exporter of deflation begins to age, the entire global economic equation fractures. The institutions are looking at the demographic pyramids, and they are executing a brutal mathematical calculation. The cost of labor in China will continue to rise. The cost of manufacturing will continue to rise. Therefore, the era of cheap goods is over. This means that inflation, the invisible tax that erodes the purchasing power of the middle class, is no longer a temporary phenomenon caused by supply chain bottlenecks. It is a permanent, structural reality. If it costs more to manufacture a microchip, a vehicle, or a pharmaceutical drug, the corporation does not absorb that cost. They pass it directly to the consumer. And if they cannot pass it to the consumer, their profit margins collapse. When profit margins collapse, the stock market valuations that rely on those margins must be violently repriced downward. The smart money saw this demographic wall approaching a decade ago. They realized that concentrating the entire manufacturing capacity of the globe within the borders of a single, aging, increasingly hostile nation was a catastrophic vulnerability. The COVID-19 pandemic did not cause the supply chain crisis. It merely exposed a fragility that the institutions already knew existed. And so, the Great Migration began. The retail market is just now beginning to hear political buzzwords like de-risking and decoupling. But the institutional capital moved years ago. Hundreds of billions of dollars in foreign direct investment are currently bleeding out of mainland China. The apex predators of global finance, the sovereign wealth funds, the mega private equity firms, and the multinational conglomerates are quietly packing up the factories. But they are not bringing them back to the United States. The political narrative in the West promises an American manufacturing renaissance. They promise that the factories will return to the Rust Belt. The institutional reality dictates otherwise. The labor cost in the United States is mathematically prohibitive. The environmental regulations are too strict. And the demographic reality in the West is that there simply are not enough young, skilled, blue-collar workers willing to staff the assembly lines. So, where does the money go? Where does the smartest capital on earth rebuild the global supply chain? It flows to the new demographic dividend. It flows to the global South. And that is exactly what we will decode in Chapter 2. Do not trust the political narrative. Look at the demographic data. Track the population pyramids. If you want to maintain your institutional edge, make sure you are subscribed. Until next time, trade the reality, not the narrative. When a global empire begins to fracture, the wealth does not evaporate. It simply changes coordinates. In Chapter 1, we exposed the demographic collapse of the traditional manufacturing hubs and the structural end of the deflationary supercycle. We established that institutional capital is abandoning the old regime and actively seeking a new demographic dividend. Welcome to Chapter 2. Today, we are tracking the flight of the global supply chain. We are mapping the exact geographical coordinates where the smartest money on Wall Street is pouring hundreds of billions of dollars to rebuild the engine of the global economy. If you are a retail investor heavily concentrated in domestic American equities, you are betting on a consumer base that is being suffocated by structural inflation. The institutions are betting on the producers. Let us look at the new architecture of global trade. The geopolitical strategists call it Alt-Asia, the alternative Asian supply chain. It is a crescent of emerging markets stretching from India down through Southeast Asia and into the Indonesian archipelago. This region possesses the two assets that global capital desperately requires: a massive, young, growing population and governments willing to aggressively incentivize foreign direct investment. Let us begin with the crown jewel of the institutional pivot: India. India has officially surpassed China as the most populous country on earth. More importantly, the median age in India is 28. They possess a massive, young, hungry workforce entering their prime productive years. For decades, India was viewed purely as an exporter of software services and back-office IT support. That narrative is dead. The smart money is heavily financing the physical industrialization of the Indian subcontinent. Massive corporate titans, companies like Apple, Foxconn, and global semiconductor manufacturers are physically relocating their high-end assembly lines from Shenzhen to Chennai and Gujarat. The institutional capital is not just buying Indian equities. They are funding the logistics. They are financing the deep water ports, the highway networks, and the power grids required to turn a service-based economy into an industrial superpower. When you track the private equity flows, the billions are moving into Indian infrastructure and heavy manufacturing. They are positioning for a multi-decade boom that mirrors the rise of China in the early 2000s. But India is only one pillar of the new supply chain. The institutions demand diversification. They will never again allow a single nation to hold a monopoly over global manufacturing. This brings us to the industrial powerhouses of Southeast Asia. Vietnam has quietly positioned itself as the premier destination for electronics and semiconductor assembly. The institutional funds recognize that Vietnam shares a land border with China, allowing multinational corporations to seamlessly migrate their operations across the border while maintaining their existing raw material supply lines. The foreign direct investment flowing into Vietnamese industrial parks is staggering. It is a silent gold rush. The factories are being built with institutional Wall Street capital operating entirely under the radar of the Western retail investor. Move slightly west to Thailand. Thailand has executed a brilliant geopolitical balancing act. They are neutral territory. And because they are neutral, they have become the absolute epicenter of the next generation automotive industry. Western institutions, Japanese legacy automakers, and Chinese electric vehicle giants are all simultaneously pouring billions into the Eastern Economic Corridor of Thailand. They are building battery megafactories and automated assembly lines. The institutions are turning Thailand into the Detroit of Southeast Asia. And further south, we find Indonesia. Indonesia controls the largest nickel reserves on the planet. Nickel is the critical component for high-performance electric vehicle batteries. Historically, emerging markets simply mined their natural resources and shipped the raw dirt to the West for processing. But the game has changed. The global South has realized their leverage. Indonesia banned the export of raw nickel ore. They told the global institutions, if you want our resources, you must bring your capital here. You must build the refineries and the battery plants on our soil. And the institutions complied. Billions of dollars in private credit and sovereign wealth are currently flowing into the Indonesian archipelago to build the processing choke points of the green energy transition. This is the reality of the Great Decoupling. The supply chain is not coming home to the United States. It is simply fracturing and spreading across the global South. So, how does the omniscient investor extract alpha from this geographical shift? You must look beyond the American indices. The S&P 500 is heavily weighted toward software companies that rely on a healthy, affluent Western consumer. If the Western consumer is being crushed by the inflation generated by this massive supply chain realignment, the software companies will ultimately suffer. You must follow the capital. The institutions are accumulating shares in emerging market logistics companies. The toll roads in India. The port operators in Southeast Asia. The industrial real estate investment trusts that own the land underneath the new Vietnamese megafactories. They are buying the physical foundation of the new global economy. But relocating the manufacturing engine of the world introduces a terrifying new vulnerability. When you fracture the global supply chain, you fracture the global currency system. The institutions are no longer just hedging against inflation. They are actively hedging against the weaponization of the United States dollar. That is the final piece of the macro puzzle. The currency war. And that is exactly what we will decode in Chapter 3. Do not be blinded by domestic political narratives. Watch the flow of foreign direct investment. Track the cargo ships. If you want to maintain your institutional edge, make sure you are subscribed. Until next time, trade the reality, not the narrative. Control the currency, and you control the world. For the last 80 years, the United States dollar has been the undisputed apex predator of the global financial system. It is the reserve currency. It is the medium of exchange for global energy, global debt, and global trade. But in the highest echelons of institutional finance, a silent rebellion is currently underway. In Chapter 1, we exposed the demographic collapse that killed the era of cheap labor. In Chapter 2, we mapped the physical relocation of the global supply chain into India and Southeast Asia. Welcome to Chapter 3, the conclusion of our thesis on the Great Decoupling. Today, we are stripping away the physical assets and looking at the abstract mathematical warfare happening in the currency markets. We are going to decode why sovereign wealth funds and central banks are quietly abandoning the dollar, and exactly how the smart money is hedging against the debasement of Western fiat currency. If your entire net worth is denominated in a single fiat currency, you are mathematically exposed to the greatest geopolitical shift of the century. Let us examine the catalyst. In 2022, the Western financial system made a decision that permanently altered the psychology of the global markets. In response to geopolitical conflict, The United States and its allies froze hundreds of billions of dollars in sovereign reserves belonging to a foreign central bank. The morality of that action is completely irrelevant to the market. The market only cares about mechanics. The mechanics demonstrated that the United States dollar and the Western banking system could be weaponized instantly. Every central bank in the global south, every sovereign wealth fund in the Middle East, and every rising superpower in Asia immediately executed the same mathematical calculation. If they can freeze those reserves, they can freeze our reserves. The dollar was no longer viewed as a neutral, risk-free asset. It was classified as a geopolitical liability. This is the psychological trigger behind the de-dollarization movement. The retail media treats de-dollarization as a conspiracy theory. They point out that the vast majority of global transactions still occur in dollars. They say the dollar is too entrenched to fail. The institutions know that transitions of this magnitude do not happen overnight. They happen slowly, at the margins, until the system reaches a breaking point. Look at the underlying data. The central banks of the world have been quietly dumping United States Treasury bonds. Historically, foreign nations bought American debt to hold as their primary reserve asset. Today, they are rotating that capital into something that cannot be frozen, sanctioned, or printed by a foreign government. They are hoarding physical gold. Global central bank gold purchases have shattered historical records over the last 36 months. They are repatriating their gold from Western vaults, moving the physical bars back to their sovereign territory. This is not speculation. This is systemic risk management. But the shift extends beyond precious metals. It is fundamentally altering how the new global supply chain operates. The emerging markets of Alt Asia, the industrial powerhouses of India, the Middle East, and Southeast Asia are increasingly settling bilateral trade in their own local currencies. When an energy-producing nation in the Middle East sells oil to a manufacturing hub in Asia, and they settle that transaction outside of the dollar network, it destroys artificial demand for the American currency. If global demand for the dollar shrinks, while the United States government continues to print trillions of dollars to fund its domestic deficits, the mathematical outcome is guaranteed. Structural, compounding debasement. The purchasing power of the currency collapses. The smartest money on Wall Street understands this equation perfectly. The private credit funds, the alternative asset managers, the elite hedge funds, they are not sitting in cash. They understand that holding unbacked fiat currency in an era of massive government deficits is guaranteed financial suicide. This is why they are executing the hard asset pivot. As we have discussed throughout this entire channel, the institutions are buying real things. They are buying the commercial real estate that is bleeding out the regional banks. They are buying the power plants and the data centers. They are buying the toll roads in India and the deep-sea ports in Southeast Asia. They are buying the physical copper and the uranium mines. They are stripping their capital out of the paper economy and burying it in the physical bedrock of the global supply chain. When the purchasing power of a currency collapses, the nominal price of a physical asset skyrockets. If you own a monopolistic toll bridge in a rapidly growing emerging market, it does not matter if the local currency loses 50% of its value. You simply double the toll. The physical asset perfectly absorbs the inflation. This is the ultimate institutional playbook. So, how do you protect your own capital? How do you survive the Great Decoupling and the currency war? First, you must embrace the reality of inflation. Stop praying for the cost of living to return to the levels of 2019. The demographic deflation is gone. You must aggressively seek assets that outpace currency debasement. Second, you must diversify your geographical exposure. The United States has dominated global equities for the last 14 years. That cycle is mathematically exhausted. You must look toward the global south. Look at emerging market ETFs that deliberately exclude the geopolitical risk of China. Look for funds that are heavily weighted toward the industrialization of India and the manufacturing boom in Southeast Asia. Third, You must own the physical foundation. If the central banks of the world are hoarding physical gold, you should pay attention. If the apex private equity firms are hoarding critical infrastructure and energy assets, you should follow their lead. The retail investor trades the daily news cycle. They are manipulated by the headlines. They hold depreciating currency while hoping the stock market goes up. The omniscient investor trades the mathematics of the human race. They track the demographics. They track the supply chains. They track the sovereign flows of capital. The world is fracturing into regional blocks. The era of perfectly synchronized globalization is dead. The wealth transfer has already begun. This is the institutional view. Do not trust the illusion of the paper markets. Anchor your wealth in the physical reality of the new economy. We will continue to decode the macroeconomic shifts, the geopolitical supply chains, and the institutional ledgers as this supercycle unfolds. If you want to maintain your institutional edge, make sure you are subscribed. Until next time, trade the reality, not the narrative.